All right, let's talk about the high stakes world of startup investing, where a fantastic pitch can sometimes hide a really fatal flaw. For every huge success story, there are just countless failures. So the biggest question for any investor has to be, how do you spot the difference before you write that check?
I mean, that's the million-dollar question, right? Everyone's looking for that next unicorn, but nobody wants to back a project that's just doomed from the get-go. The real trick is figuring out how to separate a story that sounds brilliant from a product that's actually truly viable. The research paper we're digging into for this explainer puts it just perfectly. It says startups operate in an environment of maximum risk, volatility, and uncertainty. I mean, that's just the nature of the beast. They're built on brand new ideas, often with unproven tech. But what if there was a way to slice through all that noise, to find the secrets that are hiding just beneath the surface? Well, turns out there is. And that tool is called technical due diligence, or TDD for short. Honestly, the best way to think about it is like an investor's X-ray. It's a way to see right through that shiny surface and actually examine the bones, the core structure of a technology company. So what is it exactly? Well, our source gives us this great 2019 definition. TDD is a process of analyzing the technical aspects of a product or service. It's this formal investigation that happens at really critical moments, like when a startup is trying to raise a new round of funding or it's about to be acquired. This chart breaks it down so well. Think about it like you're buying a house. Your standard due diligence, that's checking the price, making sure the location is right, looking at the legal title. But technical due diligence, that's when you hire the inspector to get in there and check the foundation, the plumbing, the wiring. It literally goes under the hood to see if the engine, the technology, is actually built to last. It asks that one fundamental question: is this tech solid? And look, this isn't just some vague concept. It's a really structured, methodical process. The paper we're looking at lays out this super clear 5-step playbook that the experts almost always follow. So it all starts with a kickoff call to set the game plan. From there, a team of experts just dives deep into all the documentation. They're looking at everything from system architecture to backup plans. Then step 3 is the big reality check, a live meeting either on-site or remote to see the product in action and actually meet the team behind it. After that, there's a deep dive Q&A to clear up any questions about patents or code. And finally, the whole thing wraps up with a detailed report that just lays out the unvarnished truth. Here are the strengths, and maybe more importantly, here are all the weaknesses. But a really thorough TDD doesn't just stop at lines of code. The research we're drawing from here actually proposes this comprehensive methodology that's built on 3 essential pillars. A complete TDD really gives you that 360-degree view. So, the technological pillar, that's the deep dive into the code, the infrastructure, the security. But the commercial pillar is just as critical. It's asking, can this business actually scale? Does it fit the market? And finally, you've got the financial and legal pillar, which protects the investment by scrutinizing all the IP, the patents, and the licenses to make sure there are no nasty hidden liabilities. Okay, so we get the process, but what does it actually find? I mean, what are the biggest red flags that pop up again and again? Well, the data from the study is pretty revealing. Get this, according to the data, a staggering 43% of all identified risks are related directly to software development. That is nearly half of all the problems they find. Another 17% are tied to hardware and infrastructure. So this tells you, loud and clear, the biggest dangers are often buried deep inside the code itself. 43%. Just let that number sink in for a second. The single biggest threat to a tech startup often lies right at its very core, in the code, the architecture, the hidden bugs, and all that accumulating technical debt. These are the kinds of critical details that a slick PowerPoint presentation is almost never going to reveal. So finding risks is one thing, that's great. But how does this whole process translate into real value? How does TDD actually make a difference to an investor's bottom line? Well, the data here is pretty clear. The experts they surveyed found that TDD directly reduces costs by 27%, and it cuts technological risks by another 20%. So by spotting these problems before a deal is signed, investors avoid all those costly surprises down the road. It just makes the entire investment safer and way more predictable. It's really all about shifting risk from the unknown column to the known column. Ultimately, all of this hard work, the calls, the code reviews, the analysis, it all boils down to one thing: a final report that basically acts like a report card. It gives investors the clarity they need to make a really smart, informed decision.
And you don't have to take my word for it. The conclusion of the source paper says it all. It calls TDE a very useful tool and a critical success factor for any investment. At the end of the day, it's not just about trying to avoid failure. It's about architecting success from the start.
So what's the big takeaway here? Think of TDD as your defense against the unknown. It's how you can verify that the code is clean, that the patents are actually secure, and that the tech has a real shot at scaling. It helps you get to a true valuation, and most importantly, it helps you avoid those catastrophic surprises after the money is already in the bank. And really, at the end of the day, TDD isn't just a negative process of poking holes in things. It's a positive one. It's all about replacing uncertainty with clarity and swapping out guesswork for genuine confidence. And that really just leaves one final question for any investor out there. Are you making your decisions with a blindfold on, just relying on a great pitch? Or are you using the X-ray to see what's really going on under the surface? Thanks for joining us.